Hello, everyone, and welcome to another episode of Economics Abridged. Today, we're going to be diving into one of the most fundamental concepts in economics that can explain almost anything through its lens. So, today, we're going to be looking at supply and demand, which, as you can see from this meme, is quite the important topic in economics. And as I said before, it can be used to analyze almost anything. So, let's jump right into it. So firstly, what is supply? Well, supply is the amount of a good or service that producers are willing and able to sell at different prices. So willing and able to sell means that the price of the product is enough to keep the lights on and make the suppliers happy, give them a decent profit. Next, price is the main component in finding what the quantity supplied is of any given good. So as you can see on the graph, we have price on the y-axis and quantity supplied on the x-axis, and price is the main component. Now there are other components that can be used to analyze the supply graph, but we'll get into that on the next slide. So for now, let's focus on the law of supply that tells us that as price increases, the numbers of producers willing and able to sell for that price increases, and vice versa, which is represented on the graph with a direct relationship and a slightly upward sloping curve. So this is pretty easy to understand. Essentially, as the price of a certain good goes up, more people are going to want to sell at that price. So for example, if you can sell something to a consumer for twice the price, then of course a supplier is going to want to sell that thing, especially if it's as easy to produce as anything else. So next, let's go into the determinants of supply. The determinants of supply that shift the supply line left, decrease, or right, increase are the following: technology, related prices, input costs, competition, and the expectations of producers. So before we get into these things, let's take a minute to look at this graph. So as you can see, almost counterintuitively a little bit, decrease means the line goes up on the graph, and you can visually see this because you need a higher price at each point along the original line to get the same amount of quantity supplied, which means the overall quantity supplied is less. And on the other side of that, with an increase in supply, you can see that the price is lower for each individual quantity supplied compared to the original line S1. So now let's get into these. So technology, if you think about it, a more efficient machine can produce more, so that increases the supply. Related prices means, for example, if a similar good to something like a baseball and a baseball bat, if the price of baseball bats goes up, then the amount of baseballs sold is going to be less because a producer would rather produce the more expensive item. So since the baseball bat is more expensive, the production company will focus on producing the baseball bat over the baseballs, which are comparatively less expensive. And therefore, even though the price is technically a factor, it's not the price of the baseball itself, it's the price of the related good, the baseball bat. So a little less complicated is input cost. This is one of the most common things that you'll come across when dealing with supply and demand questions. Input cost is how much it costs to produce something, obviously. So, for example, if the cost of wood goes up, then baseball bat prices are going to go up. If that happens, obviously you're going to produce less baseball bats because it costs more to produce each individual one, and your resources do not go up in the short term, so that decreases the supply overall. Competition, this is just a word for how many producing firms there are. If there's more firms producing a certain good, then overall there's going to be more supply across the market for that good. And finally, the expectations of the producers, which is essentially when producers expect the price of a good to go up, they will produce more in anticipation of that price rise to capitalize on that increase in price. Next, let's tackle what is demand. Well, demand is the amount of a good or service consumers are willing and able to buy at different prices. So as you can see on the graph and by the law of demand, As the price increases, the number of consumers willing and able to buy at that price decreases and vice versa. So this makes sense because you can imagine, for example, a store. If the prices of the goods in that store increase, less people can afford to buy those items, and people may want to buy less of those items overall. And this also shows why demand is graphed with an inverse relationship and a slightly upward sloping curve. As I mentioned previously, the law of diminishing marginal utility states that each additional unit of a good you buy has less value or benefit. So imagine, for example, when you go to the grocery store, you may only buy one or two things of eggs instead of three or four. For example, even if egg prices are really low at any given time, you're still not going to buy an extremely large amount of eggs because each individual egg doesn't give you more benefit if you buy it in bulk. So now we can analyze the determinants of demand, which either shift the demand line left for a decrease or right for an increase. And looking at the graph, we can see that it's a little more intuitive than supply, with an increase moving the line up and a decrease moving the line down. And you can see that at any given price, the quantity demanded may change based on the things that shift these demand lines. So you can remember what moves these demand lines through the acronym MERIT, which stands for market size, expectations, related prices, income, and taste. So for market size, you can remember this as the amount of consumers increasing causes the overall quantity demanded of an item to increase. So let's say people are having more babies, the quantity demanded for diapers will increase. Next is price expectations. You can imagine this as if somebody thinks the price of a good will go up, then they're going to buy more right now to kind of avoid that price hike in the future, causing the quantity demanded to increase in the moment. Next is related prices, which essentially means that if something is more cost effective or just overall a better deal than something else, then people are going to demand that better deal more. So for example, if you want a steak but it's super expensive, you might get a chicken sandwich or something like that instead, or you might get a hamburger from McDonald's. It's more cost effective, and especially if the steak is extremely expensive, like at a high-end restaurant, people are going to demand that less expensive good more. Next is income. As you can imagine, people having more disposable income, more money to spend, they're going to spend that money, obviously. So the quantity demanded of any given good will increase as people spend more money on that given good. And finally, taste, pretty self-explanatory. If something is trendy or it's heavy in pop culture at a certain given moment, then the amount of quantity demanded for that given item will increase in the short term. So finally, putting the supply and demand curves together, we find the equilibrium price and quantity, which is the point where the supply line and demand line intersect, and quantity supplied is equal to quantity demanded at the equilibrium price. So this is essentially the point where suppliers and consumers can come together, shake hands, say, at this price, I will buy this. At this price, I will sell this to you. So this is basically the point where people's happiness and satisfaction with the deal is maximized. It doesn't mean everyone is happy, but it means that the most amount of people are happy with the given good at this given price. And since the most people will be satisfied at this price, there are many market forces that drive prices toward this equilibrium. And we will see why in the next slide. So as I mentioned on the last slide, the equilibrium point is where the satisfaction is reached at a maximum for both sides equally. And this is best represented through the concepts of consumer surplus and producer surplus. Consumer surplus is the economic benefit consumers get when they buy at a lower price than the maximum price that they would be willing and able to buy at. And this is represented by the area between the price line and the demand line, or the cyan colored CS on the graph. So you can imagine this as a person who's willing to pay $10 for a given good, but since the equilibrium price is only $5, they're extremely happy, and their surplus for that purchase is $5 because they spent $5 less than they were able to and willing to. And so, as you can see, as the price decreases towards the equilibrium, those people who are willing to pay more, their overall satisfaction is the consumer surplus. And conversely, the producer surplus is the economic benefit producers get when they sell at a higher price than the minimum price that they would be willing and able to sell at. And this is represented by the yellow colored PS area under the price line and above the supply curve. So this is, for example, if someone needs to sell something at, like I remember in the previous example, $5 is the equilibrium price. If a producer only needs to sell something at $2 to keep the lights running, then selling at $5 gives them a surplus of $3. And that $3 represents that extra satisfaction and that gain for the producer. So you can see that as the price approaches the equilibrium, the consumer and producer surplus maximizes for each other. And for example, if you go past this equilibrium price, then suppliers will gain much more than consumers, and that will be out of balance. Or if the price is way too low, producers will not get enough benefit and consumers will get too much benefit. So this equilibrium exists because it is the point where producers and consumers can be happy without heavily encroaching on each other or making each other feel like they're getting a bad deal. So this is the reason why that equilibrium is heavily favored in any given economic exchange. So now we can look at changes in supply and demand on these graphs. As you can see, it is no longer just quantity demanded or quantity supplied. It is a quantity graph. And as you can see, the equilibrium price changes as these supply curves change. So if you have an increase in supply, your equilibrium price will decrease. And if your supply decreases, the equilibrium price will increase. And this makes sense as you think about it, right? If there's more of something, the price of it goes down because, there's more of it out there. So it shouldn't cost as much. And on the other side, with shifts in demand, if something is demanded more, the price will go up. If something is demanded less, the price will go down. Because if you think about it, if something has more demand, then there are more consumers who are able and willing to pay that higher price for something, whereas if something is barely demanded, then those same suppliers will have to lower their prices just to sell the products off their shelves. So these graphs show you that these shifts cause the equilibrium price to change, and you can see the price changes, the quantity changes. So overall, when you're dealing with supply and demand problems, you have to carefully consider how these shifts and curves will affect the price and quantity of a given good. So now we have the edge cases. So what if supply and demand both change? What if these two lines shift at the same time? And this can get pretty complicated, so we have to remember that changes in price and quantity may be magnified in these situations, and without exact numbers or clear statements, some effects may be indeterminate. Because if we don't know how big the shift in demand or supply is, some effects may not be able to be determined because they shift in opposite directions. So for example, if demand goes up, we know that increases quantity, and if supply goes up, we know that increases quantity. So we know for sure that quantity goes up. But what about price? Well, demand up means price goes up, but supply up means price goes down. So without knowing which effect is more severe, we can't tell what actually happens to the price in this situation. And the same is true when demand and supply both go down, because we know the quantity must go down, but we're not so sure about the price. And we can see the opposite when they move in opposite directions. So when demand goes up, we can see that price goes up. Same with supply goes down, price goes up. But we don't know if the quantity is going up or down because we don't have those specific numbers. Same thing with supply up and demand down for the same reasons. So with this, you can remember that if they're both moving in the same direction, price is indeterminate. See, if demand goes up and supply goes up, price is indeterminate. If supply goes down, demand goes down, price is indeterminate. And if they move in opposite directions, then you know that the quantity is indeterminate. So if the supply goes up while the demand goes down, quantity is indeterminate. If the supply goes down and the demand goes up, the quantity is indeterminate. So again, as I said, you have to be very, very careful with these If the question doesn't give you specific numbers, like say the demand went up hugely and the supply barely changed, you can't really make a decision. Sometimes you can. It really depends on the question and what the shifters are, but most of the time you're going to have to figure it out using some deductive reasoning in the question. So now that we've been introduced to supply and demand, it's important to do some review questions to refine our skills. But before we start these questions, I'd like to remind everyone that it's very important to read these carefully and make sure not to overthink these questions. A lot of the time with supply and demand questions, you can get easily confused because you may think too many steps ahead and consider too many what ifs. Like, okay, if this happens, well, maybe this will happen. And that's important, that's good critical thinking, but for economics, and this type of specific questions, you only want to be considering the very first thing that happens. You don't want to be diving into too many what ifs this or what if that. You just want to go with your gut and imagine the first step of what will happen. So with that in mind, let's jump right into it. So first question. A plant disease destroys apple orchards across the United States. How will this affect the price and quantity of apples? Next, the coldest winter on record hits the United States. How will this affect the price and quantity of heavy coats? And finally, something a little more complex, a documentary on the adverse health effects of processed meat, for example, hot dogs and burgers, leads to a movement for healthier eating. How does this affect the price and quantity of mustard? So this question is a little multifaceted, it's a little tricky, so make sure you're thinking deeply about that one. As I said, remember to focus on the first shifters only. These may be multi-leveled, but it's still that first shift that you're thinking about most importantly. I will leave the answers to these questions in the comments, and I wish you guys good luck. Stay tuned for the next video. Goodbye.